Yeah. So risk management failures, what are they and when do they happen? Okay. So explain large financial loss. Explain how a large financial loss may not necessarily be evidence of a risk management failure. So they are saying that you have to explain something how a large financial loss may not necessarily be evidence of a risk management failure. Okay, so let's see how and why. So they are saying explain how a large financial loss. So if there is a company and or there is an economy which has incurred a huge loss, but that huge loss may not necessarily be evidence of risk management failure. See, at times what happens if the if company like incurs some loss, so the blame is on the risk management department. Am I right? You did not guide us properly, henceforth there was a failure, and because of that the company has lost a lot of money, or company is into losses. So if the risk manager would have properly like taken properly would have taken those considerations. Okay, like he would have considered like there is some risk to the company and that risk has to be hedged. So maybe these kind of losses would have been these kind of losses would have been avoided, or the company would have been prevented from these kind of losses. But here the question is, they are saying that explain that if there is a huge financial loss, that may not be necessarily an evidence of risk management failure, because they are saying if the company is incurring losses, that is not necessary that it is due to risk management failure. It can be because of some other aspects also, or some other reasons also. Let's see. So the role of risk management involves, so they are saying that if a company has incurred a $1 lakh loss, if a company has incurred $1 lakh loss, so they are saying explain how a large financial loss. So here I have put the loss in front of you. It's a large financial loss, for example. Okay, explain that this large financial loss of $1 lakh may not necessarily be evidence of risk management failure. That means this may, you cannot say that this is because of the risk management failure only. Okay, so then this loss is due to what, or this loss is because of what, or what are the reasons for this kind of losses? Is risk management failure is the only reason for this, or there can be some multiple reasons for this? Let us see. The role of a risk management involves performing the following tasks. First, he will assess all the risks whatever the firm faces. Then he will communicate these risks to the decision makers. That means like these are the risks which company is facing. And then he will monitor and manage these risks and make sure that firm only takes the necessary amount of risk. But the risk management process focuses on output of a particular risk metric, example VAR. Because see, risk management, they depend on this VAR. Okay, VAR is nothing but in a given day, what is the maximum loss a company can face. So already we have discussed regarding the VAR in the first class. So they use this risk metric. This risk metric is nothing but this is one of the methods or methodologies with which they can quantify the risk, or they can know how much the company is in risk. Or suppose if I say this is like the normal distribution, this is like 95% confidence interval, this is 5% significance level, and suppose I say that on a given day, suppose 10,000 is what the company can have a loss. Okay, so I will say that like 95% the company is prepared for a $10,000 loss. 5% company is 95% confident that this is their loss and they are prepared for it, they are not scared of this. But what they are worried about is the loss should not be beyond 10,000. Okay, and there may be 5% chance that the loss may be beyond this. This is what they don't want the loss to be. This is what they are concerned with, and this is what they want to avoid. Okay, that is what we have discussed, what the VAR interprets. So and attempts to keep the measure at a specified target amount. So here we have seen that the amount what the bank has seen is, this is a specific target, like the loss can be this much. It cannot be like 95% the company is confident that the loss is this much. 5% the loss can go beyond this. So company is prepared for this. Company is prepared for this. Why? Because this is the measured amount. This is the quantified amount. Because of VAR, they have come to know that this is a loss. What this is the maximum loss what they can face. Now, when a given risk measure is above or below the chosen target amount, the firm should decrease or increase risk. Suppose the suppose the loss is going to be 11,000. Now it is a understood fact that company should reduce its risk. Why? Because the more the losses, the higher the risk the company may be taking. More the losses, more the profits is also one of the point. See, if you take high risk, there can be a high profit or high loss. So if it is going beyond this amount, company should reduce risk. And if it's going, if the loss is like suppose 9,000 something, company can increase the risk. It has scope of increasing the risk. Okay. So this is the amount, ceiling amount, which company is prepared for. And if the loss is still 5,000 only, for example, company can take high risks, no problem, because it has that vacuum. Okay, $5,000 ka vacuum it has. It can take a risk. But if the loss is beyond this, like it is 15,000, they have no scope of taking high risks. Okay, they should reduce the risks now. So this is what they can do if they know this particular amount, the target amount of risk. Okay, just a second, I'm just having some water. Now, so the risk management process usually evaluates several risk metrics. That is like example duration and beta. So duration is also one of the risk metrics and beta is also one of the risk metrics. They are saying about duration. Duration, we will discuss that afterwards. Okay, duration is a concept which we will discuss afterwards. But this is also one of the metrics of judging or knowing what can be the risk if you take a bond. Okay, so you know the high the duration. Suppose it is 5 years bond, it is 20 years bond. So when the duration is of 20 years, the risk will be high. So you want more returns in this case. If the duration is less, it's all right. You adjust yourself with less returns also. Suppose the bond is of 5 years. So 5 years duration bond will give you 7% interest. But you will not be okay with a 20 years bond giving you 7% interest. Why? Because you will be demanding at least 10 to 12%. Why? Because there is a high risk, because you have given your money to company and purchase the bond of the company, and the duration is of 20 years. So in this case the risk will be very high. Okay, so duration is one of the metrics to measure the risk. And beta tells about the market risk. What is market risk? The risk of the market. This we also called as systematic risk. So if I say beta is equal to 1 is nothing but market risk. Okay, if some company, if you are investing in XYZ company, that company's beta is equal to 1. That means the risk of investing in this company is equivalent to market risk. That means risk is very much calculated. Market risk is nothing but it contains all the diversified. Suppose if you have a diversified portfolio, the beta will be almost equal to 1. Suppose you have BSE index stocks with you, that would be the beta would be 1. Okay, but if the XYZ companies is beta, XYZ companies beta is 1.2. That means the risk of investing in ABC, let's take ABC. The risk of investing in ABC is 20% more than investing in XYZ, or 20% more than the market risk. High risk. So with this, suppose if the company is giving you, suppose XYZ company, the beta is 1, they are giving you 7%. So you will not be happy if ABC also gives you 7%. You'll be demanding more. You'll be demanding 10% because there's a 20% high risk. And if PQR company, and the beta is like 0.9. That means the risk of investing in PQR is less than investing in market, because beta is 0.9. That means this is 10% less riskier than investing in stock market or into a market portfolio. So here the risk is very less, so the returns will be also 6%. Okay, so this is what we have right now seen, like what are the metrics with which they measure the risk. Okay, just a second, Chandra, please give a reading. Just a second, I'll be here. Yeah, let's continue now. So what they are saying is a large loss is not necessarily an indication of risk management failure, as long as risk managers understood and prepared for the possibility of loss. Then the implemented risk management was successful. That means sometimes there may be a big loss in the company. That doesn't mean that it's because of the risk management failure only, as long as risk managers understood and prepared for the possibility of loss. See, if you know that this is the potential loss which the company can face, and you are already prepared for that, and you know that, and you also implemented the knowledge what you have, or you have implemented all the techniques of risk management, okay, to reduce that risk or to hedge that risk, you have done whatever you can for this to prevent the loss, but you were not successful in this, then we can say that things have not worked well for you, and you should be ready with your contingency plans. That means if plan A is not successful, we can also go for plan B. Okay, so that's what I'm saying. A large loss is not necessarily an indication of risk management failure. As long as risk managers understood and prepared for the possibility of loss, then implemented risk management was successful. With that said, the main objective of risk management should not be to prevent loss. However, risk management should recognize that losses are possible and develop contingency plans that deal with such losses if they should occur. That means, see, I am doing my job. I am teaching all the students, but I cannot take 100% guarantee that the student will pass every point of time. If the student works hard, definitely he'll pass. If he puts more efforts, he'll pass. It doesn't mean that I failed in my attempt or student failed in his attempt. Okay, probably maybe some shortcomings may there, and that has to be rectified. If 100% things are well, student will clear. If he is not clearing, that doesn't mean that it's the end. He should again realize what problems he had, and he should again move forward. And even like the if the things are not working, if the strategies of the teachers are not working with the student, they should also change their strategies. So this is what is a part and parcel of life. That means if the risk manager is putting all the efforts and trying to hedge risk or minimize the risk, and if it's not working out for him, he should change the strategies. That's it. But things cannot be like he cannot be blamed completely for that. Okay, because he has done his job with diligence, hard work, and sometimes he may not get the support like that, or he may not get the outcomes like that what he's expecting. Okay, it is not necessary that every time everyone is like successful with his policies or his strategies. Okay, let's go for the next one. Incorrectly measuring and managing risk. Suppose if you have not correctly measured the risk, suppose you have applied the VAR concept and you did not properly quantify the risk, then what? Then what can happen? So that is what here. If the risk is incorrectly measured, then what can happen? So there's a question here. Analyze and identify instances of risk management failure. They're asking you please tell us where the risk management has happened. Okay, or where the risk management failed. Sorry, where you give us some examples where the risk management failed or risk management failures have been seen, or Explain how risk management failures can arise in the following areas: measurement of known risk exposures, identification of risk exposures, communication of risks, and monitoring of risks. So where if in any of these, okay, like measuring the risk exposure or identifying the risk exposure, first he will measure, first he will identify, then measure, then communicate, and then monitor. If in all these four processes things are not going well, that can be a risk management failure. Okay, so the process of risk management can fail if one or more of the following events occur. First one, not measuring the risks correctly. Of course, that is risk mismeasurement. Okay, not recognizing some risks. Okay, if he forgets to recognize some of the risks, not communicating this to top management. He knew but he did not communicate, and timely he did not properly was not able to properly convey on time. Okay, excuse me, Chandra. So not so if the risk is not properly measured, some risks have been forgotten, not properly recognized, the risk has not been communicated to the top management, not monitoring risk adequately. Okay, that means he has not he has been careless in this, not managing risk adequately, not using appropriate risk metrics like VAR concept or beta or duration, etc., which we have discussed right now. Then there can be lot of issues, and there can be a surely there can surely be a risk management failure. Okay, so now let's see. Risk mismeasurement can occur when risk managers do not understand the distribution of returns of single risky position or the relationship of distributions among different positions. That means they properly don't correlate the things. Okay, that means one risk can give one risk can give birth to another risk. So those two risks will be correlated. So they will study them in isolation at times. Sometimes they won't club those two things and see. So this kind of mismeasurements and measurements can happen. Okay. For example, credit risk, default risk. If these two are studied in isolation, there can be issue because these two are closely correlated. How? If someone's credit worthiness is not good, there can be a default. If you don't see his credit worthiness and give him the loan, then if he defaults, then at that point of time, what you'll think? I did not study his credit worthiness. If I would have studied his credit worthiness properly, I would have not given him the loan, and this default wouldn't have happened. So if you study this in isolation, if you study this two in isolation, there can be an issue. So correlation is there, and that correlation aspect has to be studied properly. So if you do such kind of mismeasurements or don't properly concentrate on such kind of things, there can be a big issue, and the companies can face because of that. Okay. One of the examples I've explained to Chandra. Chandra, you got it? Hello?
Hello, sir. Yeah.
Yeah, you understood, na?
Hello, sir. Yeah, understood, sir.
Yeah. And proper stress testing has to be done. Stress testing is
Yes,
nothing but
yeah.
under stressful conditions how the company is operating, and
How
properly
the
things have
company
to be,
taking.
yeah, properly things have to be estimated. So all the potential things where mismeasurement can happen should be properly or should be checked, and and also whatever estimate you make, those should also be accurate. Okay. Now, failing to take known and unknown risk into account can be three forms. Ignoring a risk that is known. Suppose sometimes you are very much careless. You know that this risk is there, but you don't give much importance to that. Knowing about a risk but failing to properly incorporate it into risk models. You know the risk, but you don't incorporate that in your risk model, and then what happens? Because of that, there can be a issue in future. Or failing to discover all the risks. For example, a firm ignores known risk by failing to realize how various position risks can lead to a potential disaster. This was the case in long-term capital management, okay, which failed to recognize that high-yielding Russian debt had not only default risk but also currency risk, sovereign risk, and counterparty risk. So what happened? LTCM, okay, this long-term capital management company, this was a big company. Okay, this used to maintain all the portfolios of various institutions, like organizations, and even they had the Russian. They have invested heavily in the Russian debt, so they have taken Russian bonds. So USSR, it was a very volatile economy those days, and a lot of sanctions and all. So they had no business, and they collapsed. And because of that, the Russian debt defaulted. There was a default risk. So they did not properly study. They were very much overconfident that the government will not default. Secondly, there was a sovereign risk also regarding the country. There was a counterparty risk, and there was currency risk. The currency, the ruble, the Soviet currency fell like anything. Okay, so there was a huge damage. And for example, the managers of LTCM had thought they had hedged currency risk by selling rubles forward. Rubles is nothing but the the Soviet currency. So they have sold this currency. They had made a lot of forward contracts with lot of people and sold these rubles forward. But Russian banks on the other sides of transaction failed during the 1998 Russian crisis. You sell forward contracts, but you don't have money with you. So when the people will approach you, like, okay, fine, we have made a forward contract, now you have to deliver as per that, and you fail to deliver, then what happens? The banking system has collapsed, and it gives rise to a crisis. How the banking system has collapsed? You don't have money at all now. Why? Because of your failures in risk management. That means you properly did not like do the risk management properly, or there may be some lot of reasons or issues which you did not consider. Okay, and don't worry about this. LTCM will be studying in the financial disasters chapter. Not collecting and entering data into the appropriate risk models is another potential source. Just a second. Yeah. So not collecting and entering data into appropriate risk models, like you don't have appropriate data, and firm may take an attempt to recognize the risk, however not obtaining proper data to measure the risk adequately will have similar consequences to ignoring risk. That means you have ignored the risk, and one of the severe consequences of either ignoring or not adequately using data and risk models is that the firm might expand its operations in areas where risks are not being properly accounted for. For example, yeah, if you don't properly take risk into consideration, probably it may be like you may be going into those risky areas. Okay. For example, consider a particular trading office within a firm where the firm has made a risk allocation to the office, but then firm ignores the data generated by their trading office and does not monitor to see if allocation adjustments are needed. So what has happened here? For example, consider a particular trading office. Trading office nothing but there are many companies which have suppose HSBC Bank, it has its trading office whereby they sell securities. Okay, that's called trading desk also. So that is within the HSBC Bank itself. Okay, where the firm, that means the HSBC Bank, has made a risk allocation to the office. They have already like divided their risk by opening a trading office or trading desk. But then the firm ignores the data generated by this trading office. So now the HSBC Bank has to monitor the HSBC trading desk or trading office properly. They should monitor. They have given all charge to the HSBC trading desk. Whatever they are doing, this bank is not at all caring for that. It is just going on providing funds and trusting. So what will happen? So if you blindly follow, okay, so here you can see, but that firm ignores the data generated by this trading office and does not monitor to see if allocation adjustments are needed. That means whatever we have given to those people, how we should allocate that, like the money which we have given or the funds which we have provided, if we don't properly account for that, then those people will do whatever they want, and at the end they will just wave their hands, and they'll just wash hands, okay, with that money, and the bank will incur the losses. The HSBC trading desk, because of that trading desks unnecessarily like getting a autonomy or independence, these guys will suffer. So another example is blindly accepting a given assumption, that is AAA rated assets are very low risk, and ignoring data that would indicate the contrary. So sometimes we blindly trust on AAA rated assets. Like for example, Russian bonds. Russia is a country, and if Russian government issues some bonds to public, that will be considered as sovereign bonds, and there is a general belief that sovereign bonds never defaults, but Russian bonds have defaulted. So that this particular blindly thinking that there's a very low risk and nothing will happen, sometimes goes contrary. That means sometimes this theory goes wrong. So don't at all trust anything blindly. Okay, have a proper research. And another risk that is often ignored is increasing correlations during a time of crisis. Not recognizing the possibility of increasing correlations could potentially lead to large losses. So that means you should consider the correlations, the two kind of risks I've already explained you right now. Okay. So for example, the correlation between credit risk and market risk for banks. Of course, in the recent credit crisis market, see, if you don't, you have to assess the credit worthiness of the firms, and you should also check the market, how the market is going on. If the market is collapsing, that means the credit worthiness of the firms will not be good in that kind of market. If you give loans in that kind of market, then there is a chance of you losing your money. Some risks go completely undetected by risk managers. Clearly, some same favorable outcomes discussed previously would result. In some cases, however, unknown risk may not be too severe of a problem, but at times they may, for example, there are ultra extreme events, example, asteroid crashing to Earth. Who will think that this is going to happen? In 100 years, who thinks that corona is going to come? Such kind of risk come in 100 years. So where the probability is so low, but again, if the risk managers did not think about such kind of pandemic, then that has impacted the companies. Okay, so things have to be very properly seen, and this is the job of risk manager, and because of that, today is in so much of demand. Because seeing all these things, they should properly visualize all these things. Okay, and then they can properly see the company is prepared with funds or not in such kind of severe problems and all, and then we can say that very successfully the risk manager has done his job, and the risk management is of so much of importance. Now, risk have to be properly communicated when it arises. Okay, you cannot delay. And ongoing risk management, yeah, Ongoing is nothing but the risk manager should always be in their job. Always this process should run. Okay, and risk managers must recognize how portfolio risk profiles can change even during the absence of trading. The properties of some securities can change for several reasons. Example, changes in interest rates, embedded derivatives. Yeah, see, derivatives are what they derive their value from the underlying asset. If there's a change in those assets characteristics, definitely this will change. So these also should be properly monitored. The pricing of, see, subprime mortgages, I already told you about the subprime derivatives, whereby properly they are not applying good strategies. Okay, so that will be very risky now. Previously, the ABX indices, that is asset backed securities index, showed no variation for AAA rated tranches of securitization. I already told you what is AAA tranche. They will divide the securities into tranches. However, during the recent financial crisis, the values declined suddenly and dramatically. So what they're saying is the ABX indices, that means it's an index, stock market index, showed no variation for AAA tranches of securitization. However, during the financial crisis in 2008, the values declined of these AAA bonds also, and there was a huge loss. So people who have thought that this won't, there will be no default in this case, also their thoughts have gone wrong. Okay, because when market crashes, nothing works out. It is also important to understand that the act of monitoring and managing risk can change the nature of risk. Yeah, the Heisenberg principle says that increasing the certainty for one variable may introduce uncertainty for another variable. And marking to market in one firm, that means the derivatives are always marked to market, for example, may start a chain reaction of adjustments in other firms, which changes the risk. See, if people, what they do, they follow. If you are doing FRM, your friend will also do FRM. It's not necessary that he should do. Everyone should have their own kind of policies. There shouldn't be any kind of copying. Okay, so because if you copy at last moment adjustments, you can't do. That's what they're saying here. Another cautionary note concerning monitoring and managing this too carefully is that it could stifle a trading department's innovation. Employees should have some degree of flexibility. Yeah, you should not be rigid always. You should be flexible even, and you should be flexible in your policies. Okay, and you should always be very much wise in thinking. Okay, and firms can fail to monitor and manage risk on an ongoing basis by not having an adequate incentive structure or culture that promotes effective risk management. If risk is everyone's concern, then unabsorbed risks are less likely. That means if everyone is very much cautious regarding the risk, then there can be a chance that everyone is properly cautiously working. In addition, if compensation is a function of risk, then employees will likely take more interest in lowering firm risk. That means if the company gives them incentives that, okay, if you properly do the risk management and if you save a lot of bucks for us, we'll give you money. In that case, they will work more efficiently and effectively. That means it's like rewarding them for their work. We already discussed regarding VAR, so no need to discuss. Okay, we have already gone through VAR concept. So how VAR helps us to quantify the risk. Okay, regarding anything, if you have a portfolio, that means it will tell you about it. What VAR tells. What VAR tells. Suppose I have a portfolio, and that portfolio is of $1 lakh. Okay, so $1 lakh. So there is a chance that this portfolio may, suppose market crashes and I can have a loss of $2,000. That means on a given day, the loss can be just 2,000. I'm 95% confident. But 5% it can be more than this. So I should be prepared for this. That is what is the VAR concept. It helps us to quantify the risk. Quantify the risk in the sense, how much can be my risk on a given day. Okay, so that I can be prepared and maintain my, and keep or allocate adequate funds to overcome this, or to overcome this situation. Okay, so VAR helps in that. So we are done with this chapter, Chandra. Tomorrow we will be doing another chapter. We'll be doing basic statistics continuation. Okay.
Okay, sir. Yeah.
Yeah, and just let's see like how many chapters we have done in risk management. Here we are. See, we have done first chapter, risk management, a helicopter view, corporate risk management, a primer, corporate governance and risk management, ERM, Risk management, governance, culture, and risk taking in banks. I don't know whether we have done this or not. If we are supposed to do tomorrow, I'll teach this concept to other student. I'll be giving you this one. We have done right now risk management failures. Okay, 9th chapter. We have done GARP code of conduct. Okay, so if this is not done, that this video I'll be giving you tomorrow. Then I'm focusing on these 3 to 4 chapters. There in the morning session, those I will be providing to you, and evening I'll be taking quantitative techniques. Okay. Hello.
Okay, sir. Okay, sir.
Okay. Okay, Chandra. Okay. See you tomorrow. Bye. Go to this chapter and give a reading to this. Yeah. Bye.
Okay.